joining and taking his spot up here on stage. She's Mish Schneider, Chief Strategist at MarketGauge.com. If you have seen some of her presentations in the past or you follow her work online, you know she has a long trading career that includes trading at the New York Commodities Exchange. She's the author of Plant Your Money Tree, a guide to growing your wealth. And just so you know, when we're done here, she will actually be helping conclude the conference with her Money Masters course from 12:30 to 2:30, going in depth in terms of how she trades and gives you some serious self-directed investor advice. So if you want to check that out at the end of the conference, that will start at 12:30. Mish, welcome to the stage. Okay, all right, well here we are at the end of this thing. Let me ask you, we've heard from a couple of you already, so I want to give Mish a chance to just sort of summarize to the audience if they haven't heard anything you've said here. How do you see this market and what's sort of your view on where we stand?
Well, I have so many thoughts, so the hardest thing is to try to condense it into something succinct and actionable, since that was what we're all about today. Essentially, there's a few ways to look at this. As the election just happened, if we look at the leading sectors since the election, consumer discretionary is at the top, and the semiconductor space is at the bottom. Now, that doesn't mean that the semiconductor space is bad. It just stopped outperforming, while discretionary took over and financials also very strong, and interestingly enough, utilities. So as we're going into January, and I heard a lot of talk about the January effect, and we can talk about that some more, because January is often a reset, we have to assume that that's going to continue. Now that is something that everybody's talking about, so what I wanted to look at was something a little bit different for 2025. And my favorite word is regardless, right? So I'm looking at things that regardless, I think could do well. And in terms of emerging markets, which we just talked about, I'm really interested in Vietnam, and we can talk more about that. I don't want to talk too long. I want to give my gentlemen co-panelists here a chance. In terms of trends, I am really, really keen on anything that has to do with the explosion of the diet drugs, because it has had a major effect on everything from travel to diet to health, to beauty, to exercise, to socialization. And then in terms of the energizing the world, I think the utilities, what it's really telling us is that we need a certain level of raw materials to keep things going. And so those are my major themes. I've got other things beyond that as well.
Okay, great. We'll get into some individual names in a bit. Tom, I want to ask you, I mean, everything that you talk about is bottoms up, and that's fantastic. Do you ever, when it comes to identifying picks, say, all right, I'm going to start top down, and like your auto theme, I'm just kind of curious of your methodology there.
I do start top down. As a matter of fact, two of the biggest surprises for 2025 are top down. And it's very hard to follow a legend like David Kotok and talk about bonds. But as an equity guy here, I'm gonna step out. Don't kill me. But one of the things that I look at as a bond tourist is the Commitments of Traders report, which is published by the CFTC every week, and it shows positioning in 10-year treasuries. And the one thing that I've been seeing of late, and I made the same call in fall of 2022, is that hedge funds and large traders are the most short US treasuries than they have been since October of 2018. And if you go back and look at a chart of 10-year treasury in October 2018, it preceded a very large rally in bonds. Now, on that basis, I think that one of the surprises of 2025 is going to be that bonds get big, okay? Meaning bonds go up, yields start to compress on the longer end, and that's gonna have implications for a lot of things like the US dollar. It's gonna have implications on utilities, for instance. And I think the second big surprise is gonna be that the US dollar re-weakens. It's very interesting. In 2016, early November, when Trump was elected, the first two things that happened between the election and the inauguration were bonds sold off because he was going to deficit spend, the king of debt as he called himself, and the dollar rallied. Okay, the exact same thing happened this time. Doesn't mean it's going to repeat. There's a strong possibility it will run. The third thing, and my final surprise for 2025, is that when he was elected, emerging markets collapsed as the dollar rallied, okay, in that period between the election and the inauguration. What happened after the inauguration was exactly the opposite of what happened after the election. Emerging markets rallied. We had the biggest rally in the shortest period of time from the time he got inaugurated to 2018. Emerging markets took off. China took off, which you can't give away China, so I won't even talk about it, but we're buying it. But don't worry, don't buy it, no one wants it. You too. Mish knows. Mish, by the way, I know Mish for a while. She goes on the Charles Payne show on Fox Business all the time. Isn't that a great show? And Mish, whenever Mish is talking, I tune in, and we love going on that show. So emerging markets rallied. Same thing, bonds sold off after the election to the inauguration, rallied all of 2017, and the dollar rallied after the election, after the inauguration. You had one of the weakest years for the US dollar, strongest year for emerging market equities after the inauguration. So those are going to be the biggest surprises. In my humble opinion, we're positioning for some of those for sure.
And when it comes to names, I mean, you mentioned Alibaba is one that you're very heavy into. That's an obvious trend at play. I mean, is it as simple as for an investor who wants to use ETFs, TLT, EEM? I'm trying to think of some ways.
Yeah, that's the easiest way. You don't have to get in the weeds to do it. I mean, as it relates to BABA, for me, there's not a lot to think about. $80 billion of cash, they generate $25 billion of free cash flow, trade at 9 times forward earnings, can't give it away. Huge free option on the cloud, huge free option on AI that's not priced in, huge free option on a re-IPO of Ant Financial, which no one's expecting. And by the way, the greatest toll taker of China as they recover, they get all the middle class business, the luxury will start to pick up. Temu gets the low end garbage, Alibaba gets all the middle class and above. So
it's like Dollar Tree versus
or Amazon. It's the Amazon of China. Yeah.
Can I just say, because I want
Sure,
so,
Sam's patiently waiting.
I know.
I don't want to hold you back.
It's just it's so related to it. So yes, we're long Alibaba, and we've been buying back a lot of their own shares, by the way. And that's one of the reasons why I like
We're the only 2 people in America, by the way,
Yeah.
other than David Tepper.
Yeah, and maybe I'm the only person who's been talking about Vietnam. And
Yeah,
I think you should
that's
look at that because,
demographics are good.
well, NVIDIA just made a huge investment with AI there. The Chinese are building a highway for being able to transport goods faster, and their GDP was like 6.9%. So it's been so undervalued.
How do you expose? Do you just buy the ETF?
I buy
VNM or
VNM.
whatever?
Yeah, VNM. I mean, it's slow moving, but
I like it.
it bottomed. The other thing I want to say is TLTs, long bonds.
Perfect.
I've been watching it, and it just had a major breakout over both moving averages. And also, it would be the surprise trade, and the implications could be all of the optimism. If it's a flight to safety, that's not so good. So
Well, there's exactly, and it could be, which is the antithesis of how everyone positioned. What's the theme this week? American exceptionalism, don't invest everywhere else. That is consensus right now. It doesn't mean it won't persist for a few more years and be right, but it's possible if everyone's positioned for that. That means U.S. equities could potentially underperform, still do well, underperform high single digits, while the rest of the world plays catch up on the basis of things we're talking about with the dollar, with
and we could keep going.
Yeah.
But let's just say
Actually, I want to ask a question that goes along with it, that dovetails with what David Kotok talked about, and that is, he was saying that with the neutral rate coming down after a pandemic, I mean, that's marvelous for equities, unless we have a war. Certainly, trade could be a war. But my feeling is regarding fixed income, well, certainly bonds would do well in a falling interest rate environment, but they're also a hedge, a flight to safety hedge. So in a sense, you could almost get best of both worlds if we do get the lower neutral rate and we have a war, then the bonds would benefit on both counts. Agreed?
absolutely. That's what I actually wrote an article this week called "The Agony and Ecstasy of Long Bonds."
I love it. Wow.
Agony and ecstasy. I mean, you're talking about long bonds. I don't think I've ever used those all in one sentence.
I'll have 2 of those, please.
Sam, I have to ask you, because you and I have talked off stage about this, the whole let your winners run, buy low, sell high, and it was interesting, your point was it depends, right? Can you talk a little bit more about that point for anybody who didn't catch that?
Sure. Well, I mean, as Mish and Tom were talking about, top down and so forth, I wrote a book back in the mid-90s, again, that nobody bought, where I looked at all of the economic cycles since World War II to see when did different sectors have their day in the sun. And the thought was, well, that's sort of interesting. It was academically insightful or whatever, but that's sort of putting the cart before the horse, because if the market anticipates the economy by 6 months or more, then maybe we should be really looking at other things. Listening to the thoughts about Vietnam and bonds and so forth, I'm thinking, oh my gosh, there are so many opportunities out there that it just reminds me again that there's so much information out there that I can become frozen by indecision. And as a result, I've concluded my favorite color should be plaid. So it was like, well, what do I do with that? Okay, well, that's when that next book came out, The 7 Rules of Wall Street, where let me just follow rules. And if you don't follow the rules, then you're fired. So the thought being about, I've had many investors at money shows come up and say, well, Sam, here it is the beginning of the new year. Should I buy last year's winners or last year's losers? So should I let my winners ride or buy low and sell high? So I looked into it and found that if you had to accept one, it would be let your winners ride. Because as James O'Shaughnessy wrote in What Works on Wall Street back in the 1990s, he had said, you know, you want high momentum, you don't want low momentum, because there's an awful lot of overhead resistance. Some people who said, oh my God, I bought this dog so many years ago, now that I'm at break even, let me sell it and move on to something else. You work your way through that overhead resistance, and yeah, it can do very well. But if you're dealing with momentum, well, and you only want to do one or the other, then you want high momentum, not low momentum. But then I remembered that the right answer to most financial questions is, that depends. So my thought was, well, gee, if we have a down year like we did in 2022, the S&P was off 19.4%. Well, very, very infrequently have we had back-to-back declines in the market on an annual basis. So really what you want to do is, following a negative year in the market, as we say in New York, you want to go from foist to woist. You want to go from first to worst, or you want to sell the groups that did well in the down year, consumer staples, healthcare, utilities, and buy the worst performing groups because they have the greatest upside potential. By buying communication services, consumer discretionary, and tech in the beginning of 23, those three together gained more than 50%, or twice that of the overall market. However, following an up year, you want to stick with the winners. And so what I found was that going back to 1990, which is as far back as S&P has sector level data, if you owned the market itself was up 10.4% on average. If you bought the 3 best performing sectors from the prior year, if that prior year was positive, and held on for the next calendar year, then you ended up outperforming. But by adding that twist of alternating, meaning you buy the winners after an up year, buy the losers from a down year, 10.4 became 13%, with an 82% frequency of advance versus 71 for the market, and you beat the market 71% of the time. Take that one step further and look at the 10 best performing sub-industries, and your performance went to 18%. So 10.4 for the market, 13% by the alternate of the top 3, and then 18% for the top 10. So, you know, letting your winners ride after a good year, going from first to worst after a bad year, is a rule that I could live with.
While you have the floor then, so what would that translate into in sectors? And I know obviously at CFRA, you guys do the star ratings, you know, you identify the individual companies within that. Any names that you throw out again just for this audience?
Sure. If I just hold it like this, I can actually read it. So I'm not turning away from you. But from a sector level perspective, right now it's we're looking at communication services, financials, and tech. But as Mish just said, we have consumer discretionary coming up on the outside. So by the end of the year, it could be that we have consumer discretionary, taking out maybe communication services or whatever. So those would be the three sectors. In terms of sub-industries, I'll just quickly read the 10. Construction and engineering, consumer electronics, consumer finance, electronic components. Maybe what I'll do is I'll give the stocks along with them. So construction and engineering, ACOM is one. I try to look at both our STARS ranking as well as our Lowry technical indicators, because as I say, fundamentals tell you what, but technicals tell you when and how far. So under consumer electronics, it's Sony. Consumer finance, American Express. Electronic components, it's Corning. Independent power producers, it's Vistra. Movies and entertainment, it's Netflix. Oil and gas storage, it's Cheniere. I can't
Cheniere?
What is it?
Cheniere.
Cheniere. LNG, just liquid natural gas. LNG is all you need to know. Airlines, it's Delta. Semiconductors, it's Marvell. And then finally, wireless, it's T-Mobile. So that would be the rules-based approach of letting your winners ride with the top 3 sectors, top 10 sub-industries.
Perfect. Now, I could definitely ask more questions. I always say this, but this is your opportunity, your last opportunity really to tap into the minds that we have here on stage. So I want to leave plenty of time for your questions. The microphone's there. If you raise your hand, hopefully we can get somebody to you. Again, these guys have thrown out a lot of wonderful ideas. And if you can't get to the microphone and we don't have somebody to pass around, just, say it out loud and we'll try and translate it using the help of these wonderful populations. Yeah, if you've got somebody, if you need help. We've got a pinch hitter here, and it's fantastic. Thank you,
Thank you, Tammy.
All right. So while you may be thinking of those questions, Nish, I want to ask you, so again, when it comes to your approach, I know you're going to be giving the class in a little bit. Do you lean more here now in this market towards Tom's contrarian style? Do you like the sticking with the winners? I mean, when you're looking for ideas for this year, kind of how are you approaching it?
Well, I like a combination of both, but I also tend to look at mega trends, and then I like to track them in terms of how mature they are. Are they in their infancy? Are they middle-aged? Or are they really hitting their baby boomer stage? And then there are subcategories. So like, for example, as listening to you speak, knowing that AI, we are very, very advanced now with hardware AI, but we're really not as advanced yet in terms of stock valuations in the software part. So I'm looking at things like Salesforce or ServiceNow, or even some of the stocks that have been beat up, like Fastly, which has gotten beaten up, but all of a sudden had a nice move. I'm still even looking at 3D printing, which to me is the most puzzling mega trend that is so widely used, and yet the companies have not been able to figure out how to make any money. So it's a combination. Like, for example, I heard you say auto, so my ears perk because I've been watching Rivian, and I love Rivian for a lot of reasons. And obviously Tesla, but and there you go in terms of the mega trend. You got Tesla and you have Rivian. Made in America seems to me like more of a mega trend in its infancy. So, and then of course Bitcoin is kind of now went from an adolescent to a tween. So in terms of a mega trend, so I'm still looking at blockchain because I don't even think that has really hit its stride yet either. Again, this is something I can go on and on about, but I'll cut it there.
You got a question right here in the middle.
Thank you. So I believe in your philosophy of buying stocks low, but how do we balance that with the efficient market that they're priced where they should be?
Yeah, I did understand that. Well, Buffett's written pages about why efficient market is kind of best used as kindling for your fireplace. Look, the market is, Ben Graham said it best. Mr. Market is a manic depressive. It overshoots on the downside and in despondency, and it overshoots on the upside in euphoria. And that's what's not captured in efficient market theory, among the many things that are not captured in efficient market theory. Now, is there value in buying an index fund and just letting it compound over time and do that? Of course, it's tax efficient, etc. But if you look at across all sectors, and a lot of my clients are big business owners, real estate investors, there's a common thread, and very few of them become wealthy buying things up. And most of them got wealthy buying things when no one wanted them and waiting. And the only way you can wait is if you use limited leverage to no leverage. And why most people get hurt is because they use too much leverage and time doesn't pass, or they're impatient. As Warren Buffett says, the stock market is a device from transferring wealth from the impatient to the patient. So we want to be part of the latter, not part of the former.
And I would add to that, that there are a few things that people ask me, well, why do you look at history? Because today, history ain't what it used to be. That today is so different from 10, 20, 30 years ago. And I say, well, there's one constant with every bull and bear market since the beginning of history, and that's human involvement. And that fear is a greater motivator than greed, hence the adage that the bull market takes the stairs, bear market takes the elevator. That's also why when you count the number of 1% daily moves, 15% of them occur in bull markets, 45% occur during bear markets.
Wow.
So, volatility, fear is a tremendous motivator, and I think that's why history also works. Also, we're talking about, with indexes, I think the reason that indexes do so well is that they force you to stay in. They stop you from having your emotions become your worst enemy by saying, oh, Peter Lynch said that the problem is that most people bail out on their winners but hold on to their losers for too long. And so by combining fundamentals, momentum with technicals, I think that's the important way of at least trying to approach an index kind of return, and then being able to bail out at the right time.
Well, 100%, and I'm so glad you mentioned Peter Lynch, because I was just thinking about him, because we cannot forget about consumer instinct as well, which was what he was really famous in coining that phrase. And that goes why I'm so focused right now on the whole notion of that domino effect of the diet drugs. We have a 42% obesity rate in this country. And no, you're not obese, I'm talking about Gilbert Grape, what's eating Gilbert Grape obesity.
Everybody gets the
No, I know it's interesting, because I've never had a weight problem, but yet I'm like one of the premier voices in this now, because I know how difficult it is for people to sustain a weight loss. I've lived with it. So, is that violent for me? Well, I'm compassionate about it. Because,
Something to chew on.
Yeah. Well, no, the point is that, getting back to Peter Lynch, is that I can see the consumer instinct is changing with this technology, if you will, if you want to call it biotechnology, if you will. What's happening with Novo Nordisk and Eli Lilly and GLP-1. The Ozempic usage has more than doubled over the last 10 years. It's gone up 600% among young people. And this is alcohol consumption in terms of people who are losing weight using the diet drugs has gone down 62%. They're not eating as much pizza and junk food. And that's why I really, really love that area, because it kind of hits home to Peter Lynch. But like you said, let's not forget, I'm a technician and a fundamentalist. You have to have risk parameters, and you can't over-leverage in anything.
Absolutely. I think this gentleman here has a question.
Last 2.5 days, I've noticed most speakers are promoting the U.S. market, which I agree with. If you were to recommend an outside U.S. entity, what's your opinions or thoughts on India at this time?
I think in terms of emerging markets, there's a disparity of opportunity, and I think what you had happen as a function of ill-advised policy by the Chinese Communist government is that you had capital flight into two markets. You had capital flight into Japan, which we believe is done or not ideal, and you had capital flight into India. India has the best long-term, like Indonesia, like Vietnam, long-term demographics. It's early though. The bulk of their population is in the mid-20s. You get peak spending when they're in their early 30s to 40s. So I think what you're going to start to see is money come out of the more overvalued pockets. I think India will be less of a performer. That's yesterday's news. They've outperformed in recent years. There's a huge valuation premium in India. I think that's something to revisit down the road for the long term. And I think Japan, you had all the hot money. People probably at the conference last year, everyone was talking about buying Japan. But now that money's coming out, and I think you're going to start to see, as the Chinese government proves that they are serious about 5% GDP and serious about reigniting stimulus and taking pro-market decisions, that some of that money is going to come back into China, the hot money, the Asian allocated money that has hidden in Japan and in India as a flight to safety out of China will start to go back. So I'm less sanguine on those. I'm very bullish on India long term, but price is what you pay, value what you get. I don't think right now is the best value relative to price in that market, even though the long-term economic fundamentals are phenomenal.
100% agree. Also, believe it or not, and I'm afraid to say this, but DAX had made a huge move up in this last couple of weeks on DAX, that's Germany. And it's based on a lot of optimism, one that David was talking about, which is the idea of the interest rates coming down, and also you mentioning as well, being good for Europe. They have elections coming up. And there is something I've noticed, like Greece, years ago, that ETF got so beat up, it went down to 7, and it went up to 45 over the last couple of years, even though all the news was so bad. Forward thinking, we've all talked about this. It seems to me like that's sort of the same dynamic that's happening here, maybe with Germany, maybe a little bit Spain. I wouldn't touch France. But DAX and EWP, which is Spain, could be interesting. Let's put it that way. Limited risk.
Fair enough. I do want to make sure you have time to get set up for your class. So we've got one more question right here in the front.
Okay, great. Actually, it was 3 parts. One was, what's your top pick for the weight loss drugs company?
Well, there's categories, right? So if you wanted to just look strictly at the biotechnology aspect, the companies that are making the drugs, we are in Novo Nordisk, but I wouldn't be against Eli Lilly. I just picked MVO because I kind of like the story of the company. They actually were formed on the basis of the fact that he was a doctor and she was a student of his wife, and she had diabetes. They went to Canada, they discovered insulin, they brought it back to Scandinavia and started marketing it, became the biggest distributor of insulin. So I just kind of I like a story. In terms of, more like cosmetic type stuff, I like AbbVie. They do a lot of injectables, which is what people whose skin all of a sudden gets very loose are looking into, and that stock has been trading at a good price at around 185, 180 to 190. But I like some of the beauty stocks. I do like Ulta. I mean, they just rallied like crazy after earnings, and ELF. I'm looking at iPar. I mean, I think Nike, Lululemon did well. I think if you think like a consumer who all of a sudden now feels good, what would you buy there? That's kind of how I'm looking at it.
And just, if I've done more with individual stocks, not ETFs. If there was one ETF you would recommend, what would it be to get started?
For the diet drugs?
No, what sector is the best and the top ETF?
Well, right now I'm very interested. When we talk about consumer discretionary, I have a keen interest in XRT. I like that ETF because it's a combination of discretionary and staples. And so it kind of gives you exposure to both, but also from a technical standpoint, to Sam's point, it consolidated for 11 months in the $10 range, broke out 2 weeks ago on a gap higher, and is now consolidating once again between like 82 and 85. So I think that has huge potential. And I really do like the biotech space, IBB, and I think as we start to hear more about AI in biotechnology, it's going to be not necessarily from the medicinal standpoint, that takes years, but more from like accessing patient records or coming up with diagnoses very quickly. That's where AI is going as well.
Actually, just one quirky question. Are any of you invested in the pot stocks?
Sadly, yes.
Sadly, yes.
MSOS is like, what, $4.11? I'm just holding it at this point because this is been my most stubborn trade.
Okay, thanks.
Sam, I want to say it's going to pop, but I
Florida did not help us.
In any event, I'm not to the closing remarks, but I do want you to, say thank you to Sam, thank you to Mish, say thank you to Tom, thank you to you all for the great questions.